Index funds. They're a contentious investment class. Some investors either love them.
If you don't own stocks and you haven't been a stock investor, I think index funds are a great way to start.
While others don't like them at all.
Index funds were a very, very unpopular idea.
However, in my opinion, they are one of the most important things to know about when starting to invest in the stock market. In this video, I'll be breaking down everything you need to know about index funds. What benefit do they provide? Why diversification in your portfolio is important, and how you can choose the right fund for your portfolio. Make sure to give this video a like and subscribe to my channel to see more content just like this in the personal finance and investing space. Let's get into it. Firstly, what is an index fund? There are two parts to this question to ensure we explore this in depth. There's the index component and the fund component. Let's start with the easier piece, funds. A fund is a simple piece of financing jargon to describe an exercise where investors pool their money together in the same fund. In exchange for this, each investor receives a unit or a proportionate slice of the money they've put in. Let me break down the jargon with an example. The office is having a staff party and there is a raffle with 100 tickets each worth $1. All of the tickets are sold, meaning the prize pool is $100. Which has been pooled by everyone with a ticket. If we think about this like a fund, each ticket would represent a unit, while a raffle would be considered the fund with an assets under management of $100, representing, of course, the value of the funds pooled together. There's also a person that is managing the raffle. This would be termed in the fund world as the fund manager. The fund manager has ultimate discretion over the pool of funds and has the authority to invest the funds as they wish. They will be required to prepare a product disclosure statement, or a PDS for short, that outlines all the rules they must follow, and this gives investors the confidence to give the fund manager their funds in the first place. So, for example, let's say I started a fund called Cold Cash, and 100 people decided to invest in my fund, each investing $100. With the $10,000 in pooled funds, I as the fund manager can then invest this on their behalf under the rules specified in the PDS. If it were a New Zealand based fund, I could invest $2,000 of this into Genesis Energy, $1,000 into Spark, another $1,000 into Ryman Healthcare, and so on. Because Cold Cash and me as the fund manager have been trusted with the funds, the investors can simply sit back, relax, as I do all the heavy lifting to earn my management fee. So now let's talk about that. Fund managers create a wide range of funds to attract investment. But how are they compensated? Generally speaking, fund managers will be compensated with what's called a management fee. This is a percentage of the assets under management that is progressively taken out of a fund over the course of a year, and is generally anywhere from about 0% to 2% per annum. In our earlier example, if Cold Cash charges an annual management fee of 1%, as our assets under management was $10,000, I would take $100 of this as the fee every year. For this service, I must manage the investments, pay the relevant taxes and regulatory charges, market the fund to new investors, pay any staff I might have working for me, and that kind of thing. And for that reason, when investing in a fund, it is really important to do your research to ensure the fund manager is worth the fee they charge. To add to that, in the managed fund space, you may also have an administration fee that is charged irrespective of the fund's size. And in private equity and venture capital funds, you may also have a performance fee, which is paid should the fund have returns that exceed a benchmark. So that's a fund. Now let's discuss what an index is. When you read the financial news or hear general discussion about the stock market, oftentimes they'll talk about the S&P 500, the Dow Jones, or even the NZX 50 here in New Zealand. This is what is called a stock market index, or a standardized approach to talking about the broad market. For example, in New Zealand there's roughly 190 companies that are publicly traded via the stock market. Now instead of talking about each one individually, they sort the list by size, take the top 50 and weight them according to their respective size, and then average their daily price movements to have a single figure. This figure is a handy guide for how the stock market performed in a single day. If we look at this handy guide from interest.co.nz, we can see the companies that are components in the NZX 50 index. If you look to the right, you'll see their share, which is their weighting based on their capitalization or size. As we scroll down the list, you will see the 50 companies whose stocks are currently in the index. The NZX 50 is therefore an index for the New Zealand stock market and a leading indicator for how the New Zealand economy is going. If we look at a chart, we can see how this has been affected by recent events. Of course, in 2008, we had the GFC, when many businesses collapsed. In 2020, we had the pandemic, when many people were made redundant. And this year we have had a huge run up in inflation, the cost of living, and the economy is under pressure as a result. So a fund is simply the pooling together of funds, and an index is a reference list of stocks. When those combine, we get an index fund, which simply means that all of the funds we pulled from investors is then invested into the companies in the index. It's as easy as that. Moving on, the second question is, what are the benefits of investing in index funds? This is a great follow-up question to the first for us to cover. One of the main benefits is that from a user experience point of view, index funds are super easy to invest in. You don't need to know much about accounting, stock research, which companies are good and not. All of this is taken care of and you can just sit back and relax. The second benefit is the low fees. Because index investing relies on the fund manager simply following an index, they don't need staff to research stock ideas, which keeps the payroll down. All they need to pay for is really just a couple staff, trading costs, marketing, and that's probably about it. Fees are extremely important in the fund space, as they can heavily weigh down your investment returns over the long run if you're not careful. The management fee for index funds is generally around 0.25%, which over 30 years could still add up to a pretty large sum of money. However, in my previous video I showed a managed fund that charged as high as 3%, which as you can see adds up very quickly. Keeping fees down is therefore extremely important for investors, and this is generally why many turn towards index funds. The third benefit is that the returns you'll earn from an index fund are generally comparable or even beat the professional stock pickers over the long term. Just watch this clip of Warren Buffett, who is a large advocate of index fund investing.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now.
Buffett, of course, is one of the world's most famous investors and has been in the market since 1942 and has become one of the world's richest people on the back of it. Numerous studies and news articles have validated this view as well. And lastly, as we covered earlier, by investing in an index fund, we are investing in an index list of companies, and in some cases, thousands of them at once. This is called diversification in the investing world, which to normal folk is known as not putting your eggs all in one basket. If one company performs poorly, for instance, the index fund will generally be well enough diversified to ensure this has a minimal impact on your returns. Numerous professional investors have a few complaints about index fund investing. However, what they criticize is the investment itself and not the fact these are pretty easy to mitigate. The first is that investors have no input into the fund manager's investment decisions. This can simply be solved through having a robust investment strategy, namely core satellite, meaning you can have the majority of your funds in an index fund, but invest a smaller portion outside of this in companies you admire. The second is that index fund managers are passive instead of active, meaning they can't sell down overvalued companies, hedge to protect downside risk, or reweight the portfolio if there is a large movement in prices. These issues, however, I find a bit silly for two reasons. Firstly, passive funds have lower fees, which as we covered earlier, means you have higher returns in the long run. Secondly, when fund managers play around with hedging and reweighting, they are guessing where the market is heading. As we covered with our third benefit of index funds, no matter how expert a stock picker is, it is very rare they can consistently predict where the market is going next. So with that, we are up to our third question of this video: how to choose the best index fund for you. With index fund investing having exploded in popularity over recent years, today there are literally thousands of options to invest. If we talk about the basics and the funds that have lasted the longest time, these will be the funds that specifically invest in a single country or region. Commentators generally recommend global diversification, with much of the American discourse suggesting three funds: a US stock market fund, an international stock market fund, and a US bond fund. Outside of the US, there is often a number of local indexes with the option to invest separately in specific regions. Here in New Zealand, for example, we have SmartShares, which is a great reference here, and you can see just how many funds they offer from around the world. Aside from geographic specialization, you'll also see many industry-specific index funds listed. These would generally be considered riskier, as the fund is concentrated in a single industry, but do serve a purpose for those wanting to invest in a sector, but not a single company. An example is the Electric Vehicle Innovation Fund from Kernel. While many investors are going all in on Tesla, this fund is instead investing in a broad number of companies that are building the ancillary technologies behind electric cars. So this is another way to narrow down index fund options. The third consideration is fees. When we invest in a common index, there are usually many fund managers that offer funds with minimal differences but charge vastly different fees. If we look at the S&P 500, for example, there are many fund managers currently offering a fund in this space. This includes Fidelity, Schwab, Vanguard, State Street, and SPDR. These are among the largest fund managers in the United States. The fees they charge for virtually the same fund ranges from 0.015% to 0.16%, which is a large variance.
But I would be very careful about the costs involved because all they're doing for you is buying that index.
If we look beyond the US, many fund managers simply invest in these same US funds. SmartShares, for example, simply invest in the Vanguard S&P 500 fund, and along the way absorb fees of 0.34% for themselves, despite Vanguard only charging them 0.04%. So this is something to be mindful of. The last consideration is the format of the fund, which mainly includes funds and exchange-traded funds, or ETFs for short. The difference is basically in the name. With an ETF, you can simply purchase units through a stock exchange or a broker, such as Sharesies, Robinhood, or InvestNow, whereas a fund is usually offered directly to investors through their website. In New Zealand, SmartShares is one of the largest managers of index fund ETFs. Globally, Vanguard, BlackRock iShares, and State Street are among the largest. You can invest with SmartShares through Sharesies and InvestNow, while for global funds you can use any broker dealing in US shares, including Sharesies, Hatch, Stake, Tiger, Robinhood, Interactive Brokers, among many others. In the fund space, in New Zealand we have the likes of Kernel, which offer low-fee index fund investments through the website. To learn more about the different formats, Kernel has a great article on this, and I'll include a link to that down in the description. As discussed, the ultimate decision of where to invest is yours only. I've only shared public information here about the mechanics behind index funds and some of the largest providers from around the globe. I hope you enjoyed this video and learned more about index fund investing. If you like this video, please make sure to subscribe to my channel to see more content just like this in the investing and personal finance space. Thanks for watching, and I look forward to catching you on the next one. Cheers.